Welcome to Benchmarking by the Numbers, and our hope today is to bring these numbers to life for you and hopefully turn them into value for you and your participants. So very excited. Hope you have a lot of questions. One thing about data, it generates a lot of questions, so queue those up. We're going to try to leave some time here at the end. At least that's the plan. We'll see how it goes, but hopefully we have some time at the end for some questions. So please recall those as you go. We all got these, which these were in your seats the day we first got here. This was the 2017 Perspectives in Practice Survey Report. It was in your seat when we all started on Sunday or on Monday with the opening speaker. And this data represents 62 plans, represents 116 billion in assets, but the most important thing, represents 2.4 million participants. Have great expectations. Hopefully more and more of you will be able to participate in the survey, and the more you participate in the survey, the better the data gets. But the four keys to any survey process: collect, organize, analyze, and interpret. So we collected the survey via, we collected the data via the surveys that hopefully a lot of you participated in. We've organized it, into hopefully a palatable set of data here that you can look at. And then today we're going to talk about, this esteemed panel is going to talk about how to analyze that. In other words, what is the data telling us? And then how to interpret that. What do I do with it? So data is no good unless you can do those two things. We have a great panel here. I'm very excited. By the way, I'm Steve Gordon from AndCo. I can't remember if I introduced myself. But we do have a great panel here today. I'll start with Steve Ferber from PIMCO. He's a senior vice president in PIMCO. He's been in the DC business for 30 years. And he's participated in a lot of market innovations, including bringing CITs back into the DC marketplace and making those available as a tool for you. So really has 30 years of looking at data, thinking about that data, and interpreting ways to create solutions. So it's going to be very valuable. He's going to help us on the analysis, kind of the front end. Next will be Jean Young, down at the far end. She's a senior researcher at Vanguard. And I'm going to read a couple of her research topics: design of employer-sponsored retirement programs, psychological and behavioral aspects of participant decision-making. She authors Vanguard's How America Saves survey every year. I'm sure a lot of you have seen it. This topic was made for Jean Young, so I'm very excited that she's here. This is really what she lives and breathes every day. And then finally, you know him, you love him, he's your next president. It's kind of hard to introduce Keith. So Jean's going to be talking about the taking action, and Keith is really going to make it practical. As the executive director of the Ohio Deferred Comp program since 2003, they have 13 billion in assets, but more importantly, alone in that plan, 200,000 participant balances. So a lot of experience of taking the information, making it real, and bringing it to life. So hopefully you can leave here with some action items, but you cannot kick off a discussion on surveys without taking a very quick survey. So get ready, it's an easy one. Think about the session that you went into here today. If your plan is 100 million or less in assets, raise your hand. Okay, so we got a few. If you were in the 100 million to 250 million dollar session, okay, a lot more. 251 to 499, okay. 500 to almost a billion. Wow, and then a billion and up. Wow, we have a lot of big plans. Stats are only valuable if they inspire some kind of an action, and because of this, they're most powerful if you're surprised by what you see. So we're hoping that you'll be surprised by some of the data, you'll be inspired to action, and today will be very useful. But again, keep your questions ready, and I'll kick things off with Steve.
Afternoon, everybody. Thank you for being here. I do a lot of speaking at conferences, but generally not in crowds this large. Last time I spoke in front of a crowd this large was my bar mitzvah. By the way, that day when I was done, people came up and gave me money and gifts. No pressure, just a thought. Steve, thank you for the introduction. I forgot to train you, as I've trained my colleagues, to say I have over 10 years experience in the business. 30 just sounds far too much. But I'm really excited to be with you today. Thank you for joining. Historically, there's been information available on two types of DC plans, 403Bs and 401Ks. With the NAGDCA benchmarking tool, we now have some very valuable information on 457s. And so what we thought we'd do is spend some time comparing the characteristics of all three DC markets. So for data, we use the NAGDCA tool for 457 plans, PSCA, Vanguard, and Brightscope for 401k and 403b data. And one comment echoing Steve's comments on size. The data does matter. The data we're going to share today is just generic market data on the three plan types. But if you would like specific information on plans of your size, please feel free to reach out to me, and we'll be happy to run the numbers. You can reach me at steve.ferber@pimco.com. I also hope to be available at Dodger Stadium through November 1. Okay, so what's that? Go Indians. So much for panel unity. All right, let's get into the data. It broke down into basically three categories: plan participation, oversight, and of course I'm from PIMCO, so we got to look at investments. So we'll start with DB eligibility. You know, some of this information is not going to be a surprise. Some of it will be a surprise. But a lot of it is useful, at least, to finally have actual data. So here we're showing the amount of DB exposure the various participants have. You can see that within the 457 arena, it's much more common for participants to have DB exposure. I don't think this is a surprise to anyone, but it does flow through into some of the other information. By the way, the bar on the left will consistently be the 457 plans, the bars in the middle, 401k, bars on the right, 403bs. Here with participation rates, not much of a surprise. I work with a lot of you. I know that a lot of you are working on increasing participation rates, and also that you have some challenges, some things that don't make it a layup for you, but certainly there does seem to be some pretty big differences here, and perhaps some opportunity to increase participation. The DB exposure also sort of flows through to account balances. Here the blue bars are the median balances, and the yellow bars are average balances. You can see that indeed 457 balances are typically meaningfully lower for 457 participants than participants in 401ks and 403bs. Don't get too worried though, since most of them have exposure to or access to a DB. If you were to add up all of the retirement income that they expect to have, they're probably in better position than participants in 401ks and 403bs that don't have a DB plan. All right, auto enrollment. The blue bars here are what percentage of plans offer auto enrollment, and the red bars are the percentage that participants are being auto enrolled at. So let's start with the blue bars, automatic enrollment. Clearly some challenges within the public arena in 457 plans due to garnishment issues and other issues that keep auto enrollment down and as a challenge for many of you. We know you're working on this, and there certainly does appear to be some opportunity, consistent also with 403Bs, same thing. Generally, very little auto enrollment in those two plan types. Being the nerd I am on DC statistics, I was really excited to see the red bar for 401ks. The red bars again are what participants are auto-enrolled at. And if you think that the general guideline is participants need to save 12 to 15% in order to have sufficient savings, auto-enrolling participants at a very low number means that it will almost ensure that participants don't have enough at retirement. And so there's been a lot of encouragement in the 401k market in particular, where participants don't have DB plans, to increase the percentage that people are auto-enrolled at as a way to get them to sufficient savings quicker. And this is the first data we're really seeing on 401ks where the average is up to 4%, started at 3%. So that's a good sign. Okay, we'll move into plan oversight. Consultant use. This one surprised me. I don't know if maybe I should have asked the audience in advance, but didn't really expect to see a difference in the percentage of plans using consultants. But clearly 457s are much more likely to use consultants than are sponsors of the other two types of plans. By the way, it's kind of interesting if you, well, we'll get there in a minute. There we go. All right. Stay with me. Sorry for that. So, more consultant use in 457 plans, really interesting when you compare that with where the litigation is, right? Litigation is in 401ks and 403bs, yet there were fewer consultants there. So perhaps there's an opportunity for 401ks and 403bs to make some increases in their oversight and governance by using some consultants. I don't know exactly why. Maybe it's the use of consultants, but it was interesting to see that there was a big difference in the types of plans that have investment policy statements in place. Here, blue is that there is an investment policy statement in place. Yellow is no, and green is uncertain. You can see the 457 market really has its act together. Nearly all the plans have an investment policy statement, at least those that responded to the benchmarking. In the 401k and 403b markets, not so much, and certainly some room for improvement there, but very nicely done with the 457s. And if you overlay this information of consultant use, and you keep an eye on the blue bars, and then you look at investment policy statements, you notice a pretty good consistency there. I can't say it's cause and effect, but it is an interesting comparison to see that those that use more consultants are also more likely to have their documents in order. You're welcome to the consultants in the room. Okay, so this one's dangerous. This is plan costs. Of course, this was really interesting to see. You can see that 457 plans tend to have lower costs than 403bs and 401ks. But as you're sitting there and thinking about your own plan and your expenses, don't freak out. You may be higher, you may be lower. There's no law that says you have to have the absolute cheapest plan. And this chart does not show the value that sponsors are getting and participants are getting for their fees, nor the service level. So you got to be careful when using fees. It also varies a lot by plan size. But at least this is a gauge to give you some sort of sense of where do you fit in relation to other plans. In talking with a number of you, I heard a whole bunch of different reasons about why this might be, and no consistency. One answer may be in part, took a look at active and passive management within the various plan types. You'll see, by the way, the NAGDA information didn't add to 100, so we're using pie charts here just to normalize the data that we did get. A couple observations on this chart. First, a lot of talk in the DC market about the move to passive. Certainly there is more passive now than there was in the past, but interestingly it's coming from a pretty low base. And in fact, when you look at equities versus fixed income, you see a pretty big difference there as well. About half the assets in DC on the equity side, almost half, are passively managed. Majority is still active. But on the fixed income side, much more are active as opposed to passive. Excuse me. So you can see there more passive within 457 plans than the other two plan types. All right. A lot of discussion yesterday at the conference and questions in some of the sessions I was in about what's the right number of options, core options, excluding defaults for your DC plan. And this isn't always clear, so I want to make it is just core options here. You can see the three different markets, 401ks with 19 on average, 457s with 22 options, and 403bs with even more than that as they transition from the old type of 403b to a more 401k-like structure. I do want to share a bit of PIMCO information here, though. Each year we survey virtually all DC consulting firms. We ask them what are they recommending, and we publish the highlights of that. And one of the questions we asked the consultants this year was, what's the right number of core options? We had 69 DC consulting firms respond, over $4 trillion in assets represented, so about 2/3 of the DC world. And the answer from consultants was 10. 6 equity, 2 fixed income, 1 capital preservation, 1 inflation protection. So that's what the consultants in the industry are saying for what that's worth. Took a look at default types, and also this was interesting. The blue lines, of course, are target date, and you can see all DC plans, types of DC plans tend to gravitate toward target date. But there was interesting data as you go deeper than that. Take a look at the 457 data, and you'll see a light and a darker green bar. I'm going to go with green. I'm not exactly sure, but let's go with green. Those two are not qualified default options. The smaller bar is stable value. The larger bar under 457 is other. I don't know what other was, but it's a pretty substantial portion of 457 plans that are not using a qualified default option, and that may be an opportunity for fiduciaries to reduce some risk. On the 401k side, almost all of the options that are used are qualified defaults, and on the 403b side, it's a hodgepodge of qualified defaults, non-qualified defaults, a whole bunch of different stuff used. So again, for sponsors of 403bs, might be some opportunity to take another look. Are we on the right path? How do we feel about fiduciary responsibility and protection and qualified defaults? Might be some opportunity for change there. Okay, and wrapping it up, we'll take a look at the investments within the different plans. The 403b data unfortunately wasn't available, so here in blue I'm showing the 457, in yellow 401k. The big thing that jumps out at you is the stable value exposure difference, with 457 plans having far more stable value than other plan types, or certainly 401ks. By the way, we're positive on stable value. We've got a stable value book. PIMCO likes stable value. Don't mean to knock stable value. I'm not. But it is interesting to note the combination of higher stable value exposure and DB plans, right? And if you think about DB plans, are sort of stable value-like. So that's a lot of certainty for 457 plans and a very low level of risk. Might be something you want to think about. It's not to say that it's right or wrong, and I know and I see some faces out there of plan sponsors I've spoken with who would like to get the stable value exposure down. It's not always easy, but it was interesting to note the big difference there. All right, so to wrap it up, opportunities are there for all plan types. And I think we can learn from what's going on in each of the markets. For 457s, really I think the biggest focus may be participation rates and autos, and I know that there's a lot of work going on in this room to try to get more 457s with auto enrollment, auto escalation, and increased participation rates. Of course, it's not quite as critical as it is in the other DC markets given the prevalence of DB plans. 457s and 403bs certainly could take a look at their defaults and perhaps move to qualified defaults if it's appropriate for them and for you and your plans. 401ks and 403bs might take a look at, do we need a consultant? Do we have an investment policy statement? That sort of thing. Look, for me, this was really exciting. I love DC data and found it really interesting. I hope that you did as well, and that you get some good information out of the data. Thank you, and I will turn it over to Gene.
Well, good afternoon. I was invited to join you this afternoon because of the work I do in this publication, How America Saves. It runs 100 and some odd pages, 100 and some odd figures, but I was asked to highlight some trends I'm seeing. But first I want to make a clarification. Much of the data you just saw was from surveys, and surveys certainly have a role. One thing that distinguishes How America Saves, though, as a source is it's not survey. It is actually based on the full service record keeping platform. So I'm mining the participant behaviors, I'm mining the plan design structures that the plan sponsors have put in place. We've been doing this a long time. The publication reads out on 4.4 million participants in 1,900 plans. That's $420 billion in assets. I'm going to say right up front, it is dominated by private sector 401k. We do record keep some 403B and some 457, but it's all dominated by the 401k data. Now, as I think about retirement savings in America, particularly the private sector where DC is what we've got, it's really quite simple. For DC to work for us, and that's what I've got, for DC to work for me, I've only got to get two things right. I have to save enough, and I have to invest appropriately. That sounds really simple, right? But get outside of rooms like this where people understand both of those things and it gets a lot more complicated. But in the spirit of two things right, I'm going to start with savings, and we're going to take a look at participation rates. So participation rates at the highest level is the first metric that we need to be worried about, because in order to be saving, you have to be in the plan. And you can see that participation rates back in the year 2000 were 65%. Today we're approaching 80%. That's huge. What that means is 22% more people are saving in these plans. Okay, so that is great. You have heard, though, at this conference, I attended a number of the sessions, you have heard at this conference, in fact, you already heard it this afternoon from us, about automatic enrollment. If you want to move the dial on savings and participation rates, it really is a plan design effect. I actually know which of the participants entered the plans under voluntary enrollment, and I know which were subjected to auto enrollment. So what you see here is that 2016 number split out, and if you're in a voluntary design in 2016, the plan participation rate is 63%. Exactly the same as it was back in the year 2000. Cross-sectional data analysis, trust me, those are the same numbers. All of the improvement and more people saving in these plans is coming from automatic enrollment. Back in 2000, at Vanguard, we had a handful of plans with auto enrollment. They rounded out to 0. At the end of 2016, 45% of the plan sponsors we work with had adopted automatic enrollment, and they represent 2/3 of the eligible individuals in the plans that we work with. So that's a good news story. We have rising adoption of automatic enrollment. You also saw the statistic on the 4% default rate. We are always talking to our plan sponsors about, if you're going to do auto enrollment, the default is terribly sticky. You need to have a strong, smart design, because your employees don't know what to do. They're going to stick with, many of them are going to stick with your defaults. So in 2016, half of the plans we work with were defaulting at 4% or higher. That's double what it was 10 years ago. Even better, 20% were defaulting at 6% or higher, which is triple what it was just 10 years ago. The other thing that we work really hard on at Vanguard with these strong, smart designs, 2/3 of these plans with auto enrollment also have automatic annual increases. So as you step back and you look at this, what we really care about, in addition to participation, is what are the deferral rates doing? And so as you think about rising adoption of automatic enrollment, plan sponsors slowly adopting stronger, smarter designs, is that doing something to the savings rates we see? The really good news is when I look at aggregate savings rates, so the employees contributing this, the employers contributing that, the aggregate savings rate during this period has remained very stable. On average, it's been 11%, and at the median, it's been 10%. So if you think about all that change going on in there, that's really good. Now, 10%, 11%, you heard 12 to 15, we would concur, but I would say that 10, 11% is decent, and in fact, if everyone in the US was saving 10 or 11%, I likely would not have a job, nobody would care about all this benchmarking, we wouldn't have all this debate over retirement savings adequacy. So that's thing one. We can feel good about it as an industry, as plan providers, as plan sponsors. We have 22% more individuals taking advantage of these plans. Our sponsors are migrating to stronger, smarter designs, and we've maintained a decent overall savings rate. So now I'm going to turn to thing 2. And this chart is actually the headline chart for How America Saves, and it has been for the last few years. Here I'm showing you the proportion of participants who are solely invested in a professionally managed allocation. So 2 criticisms. People don't get in the plan, they don't save enough, we're working on that. The other thing is people don't know how to construct these portfolios. So here you can see that at the end of 2016, over half of the 4.4 million participants were in a professionally managed allocation. They were not figuring it out on their own. You can see 46% were in the target date fund. The top bar is the managed account program. In our case, that's the Financial Engines product. This is huge. We're running projections. We've been running projections in 5 years. It's going to be 3/4, and 2/3 of those will be target date funds. So why is this huge? Well, let me talk about what this is doing for portfolio construction. This is called a scatter plot. On the vertical axis, I am plotting 5-year annualized total returns. On the horizontal axis, we have a metric for risk. The red diamonds represent what the broad markets did during this period, and the dots represent 1,000 randomly selected single target date fund holders. So your first thing might be, Gene, you goofed, there aren't 1,000 dots there. The thing is there are 1,000 dots there, but within a target date glide path, whether it's mine or PIMCO's or any other, the ranges are pretty narrow if you compare us all. So the outcome is going to be similar. If we could have 3D here, the dots to the far right are our youngest participants. They stack really high, they'd be way off the page, and then our older participants moving towards the left would be closer to the page. So that's 46% of our participants. As a plan sponsor, looking at this, given what the markets did, this is the outcome you want for your participants. Let's see what happens, though, when people do this on their own. Now you can see 1,000 dots, first of all. Second of all, this is a hot mess. There is no rhyme nor reason to the age risk that's going on. It's all over the place. Some people appear to be getting it right, and maybe some of them actually are smart enough to get this right, but by and large, it's a scattershot of outcomes, and it's really not what you want for your participants. Now, if I could wave my magic wand and say, okay, all Vanguard plan sponsors, you just agreed to run a re-enrollment, we could fix this. And the Pension Protection Act does give us fiduciary relief. We could fix it to a degree, though, okay, because we still have to permit individuals to opt out of the re-enrollment. And when they do, if I were to run this scatter plot, I'd get this same hot mess. The only difference would be I would have fewer people in the do-it-yourself category. And I sort of know that because one of the things I did this past year that was actually quite interesting is I worked on a project where Vanguard produced the inaugural edition of How Australia Saves. With the guy that does the data work here in the US, our colleagues in Melbourne, and one of the supers gave us anonymized data. Now, there are some differences between our system and the Australian system. So first of all, the employer is required to contribute 9.5% to a retirement savings account for workers. The employer chooses a fund. They're called superannuation guarantee funds. I'm just going to call them supers for short. The super is an independent organization with its own trustees. The super decides what investment options are offered by the fund and what the default investment option is going to be. If I work in Australia, my default will be the super my employer selected, but I also have the right to choose amongst hundreds of public supers, and I can say to my employer, Vanguard, I want my money to go to this other super, and that's what happens. So we were very anxious to see how this was going to turn out, and no surprise, in Australia, when members elect to construct their own portfolios and do it themselves, they too create a bit of a hot mess. Now, one difference here is the default fund for members, or what they call participants over there. The default fund is a life cycle fund that maintains a 75% equity allocation until age 55, and then it starts to glide down. So those dots are like way off the page because they're all stuck in that one little spot. The other thing you notice is the home bias. But again, people are people the world over, and when we give people the option of doing this on their own, we give them the ability to potentially make mistakes or harm themselves. So two big things going on in private sector defined contribution. Rising participation rates, all attributable to a rising adoption of automatic enrollment, and dramatic improvements in portfolio construction, and that's all coming from these professionally managed options. We believed when we first started in this business that we could teach all of Americans to construct their own portfolios. We all, Vanguard, every one of your providers here, every one of my colleagues up here on the stage, have award-winning education programs, and this is our outcome. So it's a really difficult thing. And with that, I'm going to pass the baton. Read my legal disclosures, please.
Thanks, Gene. The NAGDCA benchmarking survey that you all have access to really has a wealth of information in it. My role today is just to give a few examples of how you might be able to use it, or at least how we've used it. We've actually used it many other ways too, but just want to give a few examples. And you know, Jean said, she really boiled it down at the beginning of her remarks in terms of, you know, if you want to get people into security and retirement, it really boils down to saving and investing. And we agree with that. Obviously, the devil's in the details. There's a lot more complexity to it, but that's the essence of it. And so our plan kind of looks at that same philosophy of keeping it simple. And move this on to, and so starting with that high-level checkup and keeping it simple, we look at it in terms of making it possible for employees to enroll in the plan, to invest, and to increase their contributions. And most new enrollments are through our easy enrollment process, in which the enrollees are invested in a target date fund, placed into our auto escalation program unless they opt out. It takes a couple minutes to enroll, be placed into that diversified fund, and to increase contributions every year. As Steve mentioned, 67% of the plans in the benchmarking survey use target date funds as a default option, and Gene demonstrated how those target date funds have resulted in better asset allocation. So we are interested in seeing how we compare to our peers in the use of target date funds and to auto escalation. So in this first chart, we're looking at information from the perspectives and practice. And this is information we pulled out where we're comparing ourselves to other plans. And so we're looking at the percent of assets in target date funds. And so as we look at this chart, if you look at the dark blue bar on the far left, that would be our plan. We only have about 12% of assets at this point in target date funds, as shown by that blue bar on the left. And this is below the average for all plans, which is about 22%, but similar to plans over $2.5 billion in assets on the far right. Most of our older participants with larger account balances are heavily invested in our stable value fund, which is actually higher than what was presented before as an average. Whereas many of our new accounts, because of what we've done now, they have small balances, so that it's not a big part of the assets, but they are invested in target date funds. So then looking at the percentage of participants in target date funds, You can see from this chart that, again, we're on the far left. About 50% of our participants are now invested in target date funds, which is higher than the average plan in the survey. And that the all plans, by the way, is that red bar that's next to ours. So this is evidence that our easy enrollment is working as planned, and so we have a lot of people in target date funds, but they're still with small balances for the most part. But we think that with them staying in there and with our auto escalation in place, that we hope to see a significant impact on the average balances over time. Looking at auto escalation, we do provide to our, we have about 1,900 employers, and so we have implemented auto escalation, but it's on a voluntary basis by employers. Unfortunately, only a few of our employers have picked up on that at this time. But as Steve mentioned, one disappointing data point in the NAGDCA survey is that few public plans are, well, I'm sorry, I mentioned that on auto enrollment, but we are going on auto escalation now, so excuse me on that. But we are having much more success there, actually, than in auto enrollment. And Steve mentioned that in the survey, only about 22% of the plans are using auto escalation. So I ran some numbers through a tool we have regarding auto escalation to demonstrate the potential value of having auto escalation. And if you look at the dark blue bar, what I did is I replicated the average account balance in our plan for those that are 61 years old or older by assuming to back into that that they contributed about $23.50 per pay for 30 years, earned 6% annually, as shown in that blue bar, and that's about a $50,000 balance. And if we could reduce our expenses or increase average returns by 0.5% over those 30 years, that account balance would be increased by about 9.6%, or about $4,800. And you can see that in the short green bar. Instead, if we enrolled that person with auto escalation and increased the per pay deferral, $5 per pay every year, her balance would increase by more than 200%, or $109,000, as represented by the red bar. So, you know, we want to give good investment options. We want to help them invest the right way. But, you know, I think this shows to me that one of the real keys is you can't invest your way into retirement. You really got to save your way into retirement. And so as you can see by this is a percent of our active participants that are in auto escalation. And as I told a few people earlier, we've been doing auto escalation, well, this goes back to 2008. We started out more passively, if you will, in terms of asking people to opt into it. And I've had several different ways in which we encourage that. But in the last few years, we actually got to a point where we, for all new enrollees in easy enrollment, they would automatically go into auto escalation unless they checked a box to opt out. And I believe the last data I looked at, I think about 65% of those who are enrolling right now stay in auto escalation. And so, as you can see, in those last few years, we've really jumped that up so that we're now, as I speak right now, we're over 25% of contributing participants that are in auto escalation. So we think that's one of the keys to the future for us, helping people be into a more secure retirement. So the important, the data with the benchmarking is important, but sometimes it's good to take a deeper dive to get a better understanding of what some of the data means. And in this case, again, starting with the perspectives and practice benchmarking, this is plan participation rates. And again, we're the blue bar on the right. Doesn't look too good. According to this chart, our participation rate is fairly poor. However, we've been doing our own internal benchmarking for years, and when we get a little deeper into our own data, we get a little bit of an explanation of why is that occurring. And as you can see from this just is the overall participation rate over time. It's going up, but it's staying rather consistent from about 17.2 to 18.4 in the past 5 years. And as we look at the data, though, by pension plan, in Ohio we have 5 pension plans, and all of those people in those plans can get into our plan on a voluntary basis. And we have different experience in different pension plans. So if you can see this, the lines maybe are small, but our participation rate, the 2 bottom lines, represent about 3% participation for school employees. And that's because most of the school systems in Ohio have 5, 10, or even 15 403B plans that we compete with. So it's very hard to get that participation rate up. On the other hand, we typically only compete at the city and county level with 1 or 2 other plans. So our police and fire participation rate is a little more than 50%, which is the yellow line. And as the only supplemental plan for highway patrol, the participation rate has grown from 65 to 85%. And we also know that our participation rate for state employees, our single largest employer, is 64%, as we're the only plan for that group as well. And that's one thing that the benchmarking survey does too, is it does pull out data. You can sort it out by those where you're the sole plan that provides this benefit, or if you're with competing plans. The next thing I'll look at is fees. We've heard in many of the other sessions so far about the importance of fees. As we look at this chart, again, we're on the far left. Fees as a percent of total plan assets. Our plan fees at the point of this survey were about 42 basis points. That includes both investment and administration. We're slightly higher than the other plans, over $2.5 billion in assets. So we wanted to look at some other factors that might speak to that. And so back to the perspectives and practice. This chart shows the percentage of assets that are actively managed. And although the participants have 4 passive funds to invest in and passively managed target date funds to choose from, 80% of our assets in the plan are actively managed funds, compared to 70% for all other funds. And the actively managed funds obviously have higher costs than passively managed funds. So the whole point of this is you want to start out and take advantage of the benchmarking survey to see how you compare, but then you have to take a deeper dive and you have to start looking at what the data means and why are there differences. And that gets to the bottom line of how do you improve your plan. And this is just a little more data on the program cost, but I know we're getting close to the time for questions and answers too. So it's just trying to make the same point that the fees are important. We're showing here how we're bringing down some of our investment costs over time. In fact, with changes we recently made, we're now looking at our total investment fees by the end of this year should be down to about 26 basis points. A lot of that has to do with moving from mutual funds to separate accounts or collective investment trusts. And also getting back with our investment managers and making sure that we're in the best share class and negotiating the best fees that we can get. So, the other thing I'll just say very quickly is use this data as well when you're considering new plan features. And I'll go over this very quickly, but one of the things we looked at recently was whether to offer a brokerage window. And when you get into something like that, obviously there are many factors you look at, and certainly looking at if you have participant demand for it. And so the benchmarking survey is only one data point, but one of the things we found out from this was even though there was a prevalence of plans that used brokerage windows, when you looked at the percentage of participants using them, that was very low. And I think that was one thing that factored into our ultimate decision at this point at least not to pursue a brokerage window. And similarly with Roths, we're a little unique. I know a lot of you use Roths, and this comes from the survey as well, that shows that 65% of the plans that responded to the survey have Roths. We don't currently have a Roth. One of the problems with that was we're established by state statute, and when that was done about over 40 years ago, everything in that statute referred to deferred compensation, and Roth is not deferred. So the first thing we had to do is we partnered actually with one of our competitors and went back to the legislature, and we were able to change the legislation to make sure that we could offer a Roth. And so now, with that having been done, just last month our board did approve proceeding to implement a Roth. And so having this data and seeing the prevalence out there of those plans that are using a Roth, as well as knowing that we have competing plans out there directly competing with us that have Roths, I think that did play a part into the board's decision to pursue a Roth. So just again, some samples of ways that you can use that data from NAGDCA survey to your advantage. And so just to finalize this and with a couple of takeaways, really do take time to compare to your peers, take a deeper dive where necessary, and ultimately it's to improve your plan, and that's what we all have a fiduciary responsibility to do. And so with that, I'm going to close up and we'll have time for questions.
Thank you. So we were hoping as you heard that and listened to some of the data and listened to what's going on in other places that you were running that through the filter of your own plan. And you could tell from the hand survey early there are a lot of different plans represented in this room, a lot of different sizes. What questions do you have? We've saved some time to ask. Up here? Oh, we get one.
Hi, Michael Bowman with American Funds. So we talked about fees. We've talked about where the plan participants are. When are we going to start seeing benchmarking for results, investment returns versus volatility? Because we're all talking about managing fees, but we're not talking about getting returns. And when are we going to start seeing that, comparing each other to how well we've done for our participants for unit of risk?
So in terms of looking at returns?
Returns for the participants. So if we were to measure my plan versus another plan, how did my participants do returns year over year versus another plan's participants' returns year over year? Shouldn't that really be, if we're looking at overall plan results, at the end of the year, 10 years, if I had a participant that averaged an 8% return and a participant averaging 2%, but the participant averaging 2% only paid 20 cents for it, and participant averaging 8% return paid $1 for it, does it really make a difference? Or is fees really a true concern, or should returns be a part of that as well?
I guess I would say my bias is that it gets more back to saving enough to make a difference. I'm sure we have a lot of participants that have pretty good long-term return experience. In fact, I know we do. But yet we're really falling short in terms of what their average or median account balance is at the point in which they retire. And I think that's why I think we really need to put put our work into how we can get people to save more. And that's just, some people may have a different idea on that. We have in the NAGDCA survey asked that question too about what have you done, or are you doing anything to try and measure your plan success. But I think it really gets back to how much what size is their balance, is it going to be sufficient, rather than what their return is. There may be others.
We do actually read out on distribution of returns at the participant level, certainly in the aggregate, and we can also do that for plan sponsors. And we actually use the return dispersion story in two places. In private sector, we still have company stock issues. Not your issue, congratulate yourselves. But you can see it's part of the story that I was telling with the scatter plots and the reason why we need to get participants into better diversified portfolio allocations. But you can find distribution of returns in How America Saves.
We're seeing a lot more emphasis on outcomes The difficulty there is that it's isolated record keeper by record keeper, and so as the focus changes to participant outcomes, if you can go to a particular record keeper, they can usually tell you about your plan versus their book. But I think the industry really needs to kind of pull that out, but that's very difficult because that's measured so differently dependent upon which record keeper you're using.
Yeah. Question on maybe the same thing on asset allocation. Is there a way to break out by size of plan the asset allocation? And maybe it's already there, I don't know. Percentage equity, percentage bond, or maybe I missed it.
Yeah, that data is there. We did ask everybody in the survey to indicate through the various asset classes what percent they had invested. And then if you go into the online portal, you're able to kind of slice and dice by whether it's size of the plan or what type of plan you are, things of that nature. So that data would be available.
And we would take it one step further. So once you look at your overall plan, equity allocations, or what participants are using, that tells you one bit of the story. But we actually, and again we publish this too, we do a distribution of equity exposures. And how many people have 0, how many people are 100, how many people are in the range of what we think is balanced and appropriate for working individuals. We throw in the people that have concentrated company stock, but we encourage plan sponsors. So yeah, you can feel good about your overall equity allocation, but to your point, dig a little deeper, and you need to take a look at the distribution, because there are some people that probably require some targeted education or advice.
What other questions? I'm not sure if there's another. One of the things that kind of came across my mind as you were going through the data and kind of recognizing the different plan sizes in the audience, what would be your comments on, if I'm a $100 million plan and I'm trying to interpret the data, should I interpret it differently than a $13 billion plan?
Yeah, I'll jump in. Absolutely. And the data, looking at the data was different by plan size. So I think you really want to try to measure yourself both against your peers and then see where you stand.
And I'll take the opposite view. Plan metrics are interesting, and for somebody who's made their career on benchmarking, I should never malign benchmarking. I have my job because you all like to benchmark. So at the plan level, it means one thing. But increasingly, and I tried to give you a flavor for this by showing you the Oz scatter plots, but increasingly we have another business where it's all small plans, and there are some things about the employer that will drive behavior. They tend to be related to design and wages. But when you get down beneath it, people are people are people. They respond to your signals. So Bridget talked about the fact that people anchor at the match, right? We see that all the time. They respond to those design signals. But at the end of the day, you have vast heterogeneity in the people. So if you benchmark your plan, yes, use the data to improve your plan. But if you really want to improve outcomes for individuals, you have to start to look at distributions of data at the individual level.
And I would say they're both right, because it comes down to what Keith had said about digging deeper, right? If you see you're at a line, let's say you're a plan and you're in 41 basis points, including investment, I think is what your all-in expense were. If I'm a $5 million plan in the middle of Iowa somewhere, I may not be able to competitively get that type of a rate, but there's a lot I can learn from the participant, from 2 million plus participants in the survey, and that absolutely applies to my own participants and their behaviors. The other thing that you want to keep in mind are the different, and I think you mentioned it, Keith, I guess different plans are using their vendors differently. They have different access to wholly different tools. And again, a $5 million plan may not have, or even a $100 million plan may not have some of the tools available that a $13 billion plan would have available. So it requires dig a little deeper, think about what you can do, and when you parse it out, look at similar plans, but then you can step back at the participant level and benefit from the larger plans as well. So any other questions? There we go.
Hi, have a smaller plan, and this is our first time here. Could you maybe refresh our memory as to how we get to this data?
Yeah, the data is on the NAGDA website. So if you go out to that website, and I think if you click on publications, there's a drop down, and I think you'll see perspectives and practice. Now, what I don't know, I mean, if you looked a week ago, it would have been the data that we were just talking about here that was last year's data. We just published the new data, and I don't know if that's actually on the website as of today or not, but if it isn't, it's going to be on very soon. And then within about 2 weeks, Industry Insights, who partnered with us on this, indicated that they will then have the updated data on the online portal, so you can go out and access that and do your own slicing and dicing. But I'd suggest go out to the website, and you can certainly view last year's data, if not this year, or both the data points.
Any other questions? Well, I think we heard some good input from our speakers today. I would say, one of the big things that I think you've heard in every session is you have a lot of tools in your belt: plan design, auto escalation if it's allowed in your state, auto enroll. That a lot of plan design tools that are at your hand, and you can really affect this behaviorally. Again, just take a look at the data, dig deeper, and go from there. So thank you to the panel.